right. Well, let's see how we're going to put it into practice and get into your pro picks.
Yes.
Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, we're back with Earl Davis of BMO Global Asset Management. We're talking his pro picks, his best ideas, and you mentioned you like corporate bonds here. Let's talk about the specific issues that you like. The first one is the Fairfax bond going out to 2034. What do you like there? It's a 4.7% coupon.
Yeah, what I like there, Fairfax, they've actually been upgraded 3 times in the past 3 years. And part of that reason is they have such an acute focus on operational excellence. And to be in the property and casualty insurance business, you have to have that. So their premiums, their gross premiums every year is $32 billion. So what that allows them to do is withstand a number of disasters across the year. It's a very well-run company that can support their spread. So their spread, for example, on a 10-year bond, so let's call it a 9-year, 2034 maturity, is 115 basis points higher than the government bond. So you're able to buy their 10-year bond and get 4.70% coupon interest. I mentioned how important coupons are, which is above the level of inflation, which means you'll always make what they call a real return to be able to buy more stuff, not less, when it matures. So we really like that one.
It's interesting you talked about it being upgraded 3 times. How important is that criteria, buying bonds that you think like the credit quality is going to improve? When you talk about upgrades, it's not like an analyst upgrading. It's these rating agencies that decide, are you AAA, are you BB, whatever.
So it's very important. So it's very important because it just means you're still going to get the coupon. You're still going to get your bond maturity. The biggest risk with a corporate bond is default. If they default, you don't get back your money. So that's the biggest risk. So why that's important, it's reflective of either one of 2 things, and this is both: a good company, a very good company, and good operating model, or a good sector to be in. And they're at the point where they're very well capitalized and great company and could be opportunistic on their purchases.
So kind of a lower risk way to get a bit more torque in corporates. And I would imagine your second idea, Enbridge, at 3.1% and goes out to 2033 is similar idea, maybe even more of a safer play?
Yes, a very similar idea, slightly safer play because it's a lower maturity bond. As we spoke about the importance of maturities, you get back your money sooner. Globally diversified company, a majority 50% plus in both companies' revenues come from North America, but they are globally diversified. Very well regarded, just had record profits. So we like that, especially with our view of Canada and what's going to happen with the infrastructure expanding and just the growth in commodities. We think they're a very well-placed company to be able to support their coupons.
But you did bring one spicier pick.
Yes.
I like that.
Yes.
So this is a high yield play. Talk to me first before we get into it. Top Aces is it and a 9% coupon. What is your approach, or what's the guiding light, golden rules of high yield investing? Yeah,
so there's basically 2 types of bonds, it's called. There's investment grade, what we just spoke about, very well regarded companies, safe companies, long-term holds. And then there's high yield. So what makes a bond high yield? It's either one of 2 things. They're either in a declining industry, something that's not doing well. And why that's bad is that means the company will make less money, less ability to support the bond payments and coupon payments. The other thing, so we just spoke about the industry or sector they're in, can put them in high yield. The other thing is the amount of debt they have. They may have much more higher than average or your investment grade debt, which again puts stress on the payment or future payment in case uncertainties happen. So what we look for in that case is something that's in an industry that is growing, where their revenues could grow and support the debt going forward, which makes us feel comfortable with owning in a high yield. But it's exactly that. You get a higher yield on that bond, which is very nice to add to your coupon income.
So Top Aces, tell me about that and which bucket it fits
in. No, Top Aces is a very interesting company. It's a Canadian company. They just had their first bond issuance in March, came out at 9%, which is basically 550 basis points over the 5-year government Canada bond, more than double the pickup.
Yeah.
But what they do, they specialize in simulation, flight simulation, fighter jet simulation. They're the only company in the world that uses like F-18s and has virtual fighter jets. So with the defense industry spending, they actually train fighter pilots cheaper than local armies. So they're based in Canada, US, and Germany. Very attractive company with the fundamentals supporting their ability to withstand debt payments.
Well, that's what I was going to ask. Like when it's a new issue like that, like what kind of homework are you doing to make sure they can do that?
You got to do a lot of homework. So the homework is not only looking at the financials, which you could get through rating agencies and all that, but speaking to management.
You do that as bond investors.
Yes. Yeah. We have a credit analyst, dedicated credit analyst as part of our team. And they go out and they speak to the management, ask the questions beyond what you get by just looking at the financial statements of the industry and just doing, you literally have to kick the tires.
All right. Yeah. Earl, thank you so much. What a pleasure to be with you.